This is the Daily Market Rundown live from the Tradelo trading floor. It's June the 24th. Some highlights from today's show. Isreal Iran agreed to a ceasefire. The euro-dollar is closing at 52-week highs, and the S&P record highs are now in view. Good day, traders, and welcome. Let's get stuck straight into it. Looking across the board, of course, we know that we had the very positive news at the open of Globex with the US president effectively declaring Israel and Iran have agreed to a ceasefire. We then, of course, saw Israel come out a little bit later on and effectively confirm that their mission is now done, their objectives are achieved, and they adhere to the ceasefire. We do have one or two final barrage of missiles go off, but in effect we are now in a ceasefire, and what that means ultimately is the narrative effectively is going to shift. And it's important to understand firstly what it means when a narrative shifts, and then also what the implications are for markets, as well as what comes next. Okay, so with that in mind, let's get stuck straight into it, onto our first topic. Now, I'm not going to talk too much about the ceasefire. You can go read about that yourself, but the key takeaways from this, and what I want to stress, is that we really can see that if we look up at the grid in the top right hand side, we can see how energy prices in general have now given back all of that risk premium, that geopolitical risk premium that has been priced in since the attacks began 2 weeks ago. Now, the key takeaway from all of this is that, of course, that does mean a little bit less pressure on bond yields. We do know there was a little bit of an impact, of course, with regards to higher energy feeding into inflation expectations. And what we can also see, very importantly, is that gold has now also given back quite a bit of that risk premium that was priced in. And notable, as I mentioned yesterday, in yesterday's stream when we spoke about silver, ultimately we can see that outperformance by silver again. Okay, and this is going to remain the case until such a point, like I said yesterday, that we do get an update on the tariff situation. Okay, silver will remain stronger than gold, particularly in the near term, particularly because it has broken out of key levels, but also because we are seeing a surge in demand for a number of base case reasons. Now, what I want to take away from ultimately all this news flow is that we've now ended a narrative. Okay, in other words, this geopolitical risk, this Middle East conflict, sure, there is still going to be some commentary, sure, there is still going to be perhaps one or two flare-ups, but the reality is that the narrative is now done and finished. In other words, the market is done with this narrative, unless, of course, we did get a flare-up, okay, unless if suddenly war broke out again, they start shooting at each other, fine, maybe we get a little bit of movement on that, but in reality, what's done is done. This narrative is put to bed. Now, what that means is the market is now wanting a new narrative. And what's going to happen ultimately in the next 2 weeks is we're now going to move on to a number of different narratives that the market's going to consider. And that's what I've listed for you here on the top right-hand side. Okay. Now, first and foremost, I think in terms of the order of what's going to come, I think the record stock market prices is going to come up first. Now, what does this narrative mean? Well, keep in mind that, of course, a lot of money managers have not bought into this rally. We know that institutions have been on the sidelines mostly for this rally, and it's been retail that's ultimately been behind this rally. Now, what this means ultimately is that as we get into these record stock market prices, institutional flow, the CTAs, they're all going to be forced into buying the high tick. And so what that means is we could be in for a summer of rallying. Okay, that is very much what this narrative could be about. It could be about this perfect scenario where the Fed can cut ultimately this year, inflation is coming back to target, growth is not as bad as expected, and ultimately we get up to those record high stock market prices. Okay. Now, in terms of some of the other narratives, I think the one that's going to come in thick and fast that runs a little bit counter to the idea of record stock market prices is, of course, the Liberation Day tariffs. Okay, right now, that's been pretty much on pause, for the last 90 days. But we do know that 8th of July deadline is coming thick and fast. And so ultimately, the market's going to refocus now on the tariffs because we don't actually know what the implications are going to be. Now, keep in mind that these things all work in conjunction. In other words, if the President of the United States sees stock markets at record highs, the last time he came out with Liberation Day tariffs, the markets could not go down. In other words, nothing could send the equity markets down, and so he then went with these Liberation Day tariffs because ultimately he had that sort of maneuverability. Now, it could be a similar case where, ultimately stock markets are back at record highs, bond yields are well behaved. He's got that opportunity now to perhaps re-establish that leverage that he had back in April. So again, we need to watch the headlines here because we need to understand where is the President of the United States going with these tariffs, because right now we just honestly do not know. Okay, what we do know is that he has backed down, but we don't yet understand the what next. Okay, and the market is by no means hedged for a repeat of Liberation Day. And that's important to stress because should the president come out today, should the president come out and say, look, guys, you've got 2 weeks, and I can tell you right now, Europe, you're going to go back to that 25% tariff. Anything along those lines is going to scare and jolt the markets. Okay, so that could be a narrative that ultimately shifts in the next 2 weeks. We know, of course, Chairman Powell is in the firing line again this weekend. We know the president had a go at him. The reality is that this isn't going to change. Okay, I think the Chairman Powell narrative could ultimately pick up speed. We do know that the president is potentially picking his next Fed chair, and I think the announcement of the next Fed chair ultimately is going to matter. But the key takeaway here is, should we get that sort of shadow Fed chair put in place a lot earlier than expected, okay, almost a year ahead of schedule, ultimately that is going to create some concerns for markets. The markets are going to try and assess, how effective can Chairman Powell be. Now, we do know, of course, Chairman Powell is speaking a little bit later on today, so we will, of course, cover that in a few slides' time. But finally, the other narrative that the market's going to start picking up on and trying to understand is this big, beautiful bill. Okay, we've been talking about this over the daily market rundown and the implications, particularly the inflationary implications. But right now, we know that's passing its way through the Senate with a number of adjustments. So we just don't know where that bill is going to land. And that, of course, could be another narrative that the market tries to pick up on. Okay, the key is that for us as traders, we always need to know what is front and center in terms of the narrative, because that is what's going to drive prices. Okay, now with that in mind, before we move on to our topic number 2, a quick word about rain trading. Do you have the trading skills, but you just don't have capital to leverage those skills? Well, Rain Trading is the only traditional prop firm that invests in futures traders. Join Rain today and you're entering an ecosystem with 8-figure traders, access to the TT platform, mentorship, and unlimited scaling potential. If you're serious about a career as a professional trader, click in the description below. Now let's move on, of course, and talk a little bit about the oil price chart, because we can see now that risk premium has been given back, and no surprises there. Look where we stopped, right on that oil breakout. Okay, we spoke a little bit about this yesterday. Ultimately, I thought we'd get back to that 200 moving average pretty easily. We, of course, extended that into that breakout gap. Now, what I expect to see is perhaps a little bit of sideways trade. Okay, the market needs to kind of digest all of this now, find a little bit of value, perhaps 64, 68, that's support, that's resistance. But long term, ultimately, I suspect there's going to be more downside below 64s in the coming weeks. So keep an eye on oil. I do think it's going to be a market that's going to establish a pretty nice range now, and quite a tradable range for us as traders. Now, with that in mind, let's move on to our topic number 2, because front and center is US rates. Something interesting is happening in the US rate space, and I think it means a great deal. Now, cast your minds back to last Friday, as well as, of course, yesterday. We've now had 2 Fed members come out and open the door to a July cut. Now, that doesn't mean they're going to cut in July, but if you've been following the Fed for a number of years, typically what happens is we get these sorts of signaling that then leads to some form of follow through. In other words, what I'm leaning on is this idea of a July cut. Ultimately, before a week ago, was just non-existent. No one thought it possible, and now there's roughly a 1 in 4 chance of a July cut. In other words, it does look as though the Fed is prepping the market for an insurance cut in July. What is an insurance cut? It means they cut sooner rather than later. Now, of course, they've told us via the dot plot there's a big split, but we know that the split is somewhere between 1 to 2 cuts this year. Okay, now an insurance cut ultimately just allows them to cut sooner rather than later, because the impact of cutting sooner versus later makes no damn difference. Okay, the point is that if ultimately there is some concern that inflation's coming down. Perhaps the tariff situation from that imposed by the President of the United States is perhaps it's not as bad as expected in terms of inflation expectations, and so the Fed would rather cut ahead of time, given they are still very restrictive in terms of where their policy rate's at. Okay, now ultimately we can see in the green line US rates are pushing higher, and they're pushing higher not necessarily since the Fed comments came out, but effectively a little bit before that, since we had the last CPI print. Okay, and I think that matters because we know we've seen 3 soft prints in a row in inflation. We know, of course, the Fed expects more inflation over the coming months into the summer. But the key takeaway is that the market is getting ahead of that. Okay, right now the market is sensing the soft data, they're sensing the weaker CPI prints, and they're starting to get to work on perhaps pricing rates not just a little bit quicker, but perhaps also a little bit sooner. Okay, so in the blue, what we've got is the rate cuts pricing for this year. We can see that that is at 2 full cuts, but we've done 10 basis points since that last inflation print. Okay, we can see, of course, if we look further out to the end of next year, we can see the market's now talking about 5 rate cuts over the course of this year, next year. So that's 1 additional cut to where we were perhaps at the start of May, right? In other words, the market's turning a little bit more dovish on the Fed, and I think this matters a great deal because one of the key markets, which we're going to have a look at in a moment, is the dollar, and I think that's why we have to pay very close attention to the rates, because they are the dollar space is not quite pricing in a Fed cutting sooner than expected. Okay, now the surprise index from Citigroup really does showcase that softening in the data. We can see that we have the index pretty much at the lowest it's been since that recessionary fear that we had in July, August last year. Okay, in other words, the data points are missing. The key hard data points are missing. They are weakening, and this is why we're seeing these Fed members come out a little bit more dovish. Okay, don't be surprised if we get a few more weak data prints. We of course have got PCE out later this week. If that misses as well, don't be surprised to see this index move lower. Don't be surprised to see the rates markets move higher, and as a result of that, we are going to see that dollar get hit again. Now, the key market to trade against the dollar is, of course, the euro dollar. There's a number of other markets you can look at. I know the Norwegian krona is one that is the star outperformer this year against the dollar. Ultimately, they do have very elevated rates relative to the rest of the world. But again, it's not the thickest market in the world, in terms of liquidity, which is why the next best option is the euro versus the dollar. Okay. Now, looking at the chart, this is effectively the series of moving averages, and what we can see is the 20-day moving average is pointing very aggressively up and to the right. Okay, now typically this showcases trend in a market, and typically when you have this depth or this sort of steepness in the 20-day, ultimately the 20 and the 50-day are very, very key levels of support. Okay, we tested that level of support back in May, and ultimately now we are set today to close at new 52-week highs. Okay, what are 52-week highs? Well, it's basically just the highest price in a year. Okay, what that means ultimately for the euro dollar is, we are in price discovery mode, and ultimately it's not a market you want to be short of. It is very much a market that I suspect, now that we've ultimately normalized some of the overbought territory for the last 3 months, I do expect this trend to very firmly accelerate to the upside. Okay, keep a very close eye on euro dollar. Should we get the Fed opening the door to a July cut, that euro dollar is going to find its way very quickly up to 120. Okay, it's a prime candidate for a surge, not just technically, but also fundamentally. There is the daily chart, and again, just to showcase, if we look at what the ECB pricing is versus the US, they are moving in opposite directions, and this is always a very strong signaling, a rate divergence. The ECB is talking about pausing and perhaps being done, whereas the Fed's now talking about perhaps bringing rate cuts forward and perhaps cutting a little bit more than expected. Okay, that sort of divergence is absolute rocket fuel for any exchange rate. Okay, keep a close eye on that. I think that euro dollar is now primed for a rally higher. Now, the play of the day does come from Chairman Powell. We do know he's up testifying today, just a week after the FOMC meeting. Now, again, I don't expect anything to come from this. Why? Well, because Chairman Powell is not about to buck the trend a week after he came out and told us pretty much exactly what we need to know, which is right now uncertainty peaked in April. Right now it's appropriate to hold where we are able just to learn more. Okay, and right now they expect to see more inflation in goods coming in the summer. Okay, the reality is the general consensus at the Fed is that tariffs will have some pass-through effect of inflation. They don't know how much. They've obviously penciled in some degree of it, which is why they revised up inflation for this year. But the point is they're going to wait to get through the summer, or at least Powell wants to wait to get through the summer before they actually move on cutting rates again. Now, it's not to say that will be the case. Okay, like I said, we are only one big data point miss away from the Fed cutting. In other words, we've got non-farms in just over a week and a half's time. If we get the weakness in July from that non-farm payrolls, the Fed will be cutting in July. Okay, so you've got to keep a very close eye on that hard data. I think right now it's fine to assume a 50-50 chance of a July cut. I think ruling out a July cut is a bit naive right now because we are starting to see ultimately the Fed test the idea of a July cut. Now, we do, of course, have the VIX sitting somewhat elevated contextually. What do we mean by that? Well, there are very few risk events now for the equity markets. We, of course, cleared the Middle East tensions. We do, of course, have the tariff situation, which comes back into view perhaps later next week, but we're not there next week. We've still got a week between now and then. And so what that means is that VIX has got a lot of downside opportunity today to come and retest those 17 levels and fill out that gap. We do, of course, have that gap from yesterday that's held, and I do expect very much VIX is going to get squashed down the page today. Now, what that means ultimately is that record high territory comes into view today. Okay, if we did not trade record highs today, I would be somewhat shocked. Either today, tomorrow in the overnight session, we're probably going to be testing in this record high territory, and gap rules are in play today. Okay, we broke out of that little bit of a structured range, that 3-4 week range. We broke out there yesterday, and of course with that VIX now being squashed, I do expect ultimately we're going to go up to record highs. Now, what are gap rules? Very important to understand. Go have a look at Europe. So you can see Europe has held on to its gap rules. In other words, it gapped up, tested somewhat the gap to the downside, but sustained the gap and then rallied very aggressively. Hence why the DAX is up 2% on the day. With that in mind, how will this play out? Well, what we should see when the cash opens, we should see perhaps a little bit of a move down. Again, the depth of the degree to the downside is perhaps going to be quite shallow because I suspect everyone wants this trade today. And so you're going to get a little bit of a test to the downside. But once the market fails to fill in any part of that gap on the cash close yesterday, the market's going to start to bid its way back up and then, of course, extend the overnight high range. So keep a close eye on that. I think it's very much a case of you've got to be in on that first dip. You've got to be looking to play for the breakout of the overnight range. And ultimately, this is now just a slow grind back up towards record high territory. Okay, there's very little that stands in the way of the equity markets right now. And if anything, I do expect a little bit of chase today once the cash market opens. Okay, so that is our play of the day. It's very much looking to target record high territory. What happens beyond that? Again, I think that's going to come down to flows. That's going to come down to positioning. That's going to come down to what institutions do. I do expect that perhaps we all want to get a little bit more clarity on the tariff situation. So should we get the President of the United States telling us that he's going to give extensions to the 90-day extension, well, there's your green light. Okay, any form of extension to the 90-day extension, you've got your absolute green light for the markets to break out of record and obviously continue to rally. Okay, with that in mind then, if there are any other questions, do post them in the Discord channel. We're a little bit light on the economic data today. Of course, we do have Chairman Powell, so do pay up attention for that. What I would suggest, of course, Chairman Powell is a risk event, and what sometimes happens is the market just wants to wait for that risk event to clear. So it may well be the case that the absolute best time to buy is once Chairman Powell's statement hits the lines and he says absolutely nothing new. That may be the time at which some of the players, some of the participants start to put money to work, and we move our way through the overnight highs. Okay, with that in mind, of course, always manage that risk. Good luck out there. Manage that risk. Go make some money.